Hello, I'm Tom Selby, AJ Bell's Senior Analyst, and welcome to Fundamentals, where I'm going to look at the Vanguard SP 500 Exchange Traded Fund, or ETF, one of the most popular ETFs on the Youinvest platform right now. This product's designed to track or mirror the performance of the underlying assets and deliver that performance minus any running costs. This means this particular tracker is following the America's S&P 500 index. In this case, the Vanguard SP 500 uses physical or direct replication to generate performance, meaning it owns the underlying securities. The 5 biggest stock weightings include tech firms Apple, Amazon and Microsoft, oil giant ExxonMobil and health and personal care expert Johnson & Johnson. The chart to my left shows the tracker's weightings by sector. The biggest exposures are to technology, healthcare and financial services, while mining, utilities and real estate are relatively underrepresented. The product comes with an ongoing charge figure of just 0.07%, an amount only matched by 4 trackers and beaten by none. The tracker has over $14 billion in assets under management. It's a huge fund, so it should in theory be liquid, at least under normal market conditions. It was first launched in May 2012 and comes with a 5-star ranking from Morningstar if you attach importance to such ratings. Note that the Vanguard S&P 500 comes with dollar and sterling priced options. This chart shows the performance of the sterling version since its launch. So those are the mechanics, but why are investors buying up the Vanguard S&P 500 ETF in their droves right now? There are a number of possible reasons. The spectre of uncertainty created by the UK's decision to leave the EU in June could well be influencing people's investment choices, with the US perhaps viewed as a better bet to deliver growth. It's worth noting that the influential Atlanta Fed GDP Now forecast is expecting 3.6% GDP growth on an annualised basis for the third quarter, versus the 2.2% rate seen in the UK in Q2. Secondly, the pound has sunk like a stone since June 24th, increasing the value of holdings that are priced in dollars. And third, the S&P 500 index offers exposure to sectors where the UK is less well represented, including technology, an area that may appeal to some given its potential for secular, organic growth almost whatever the economic weather. And finally, the US Federal Reserve has backed away from a mooted 0.255% rise in its target rate 4 times this year, with some now even suggesting a rate cut could be on the cards. The prospect of lower rates for longer could provide support for US stocks, given the lowly yields offered by cash and US Treasuries. This is not to say there are no risks. There's still the possibility of President Trump taking the top job following the election in November. While it's easy to argue that US stocks are expensive relative to their history, using metrics which do not rely on habitually optimistic near-term earnings forecasts from analysts. The first is market cap to GDP. The second is Case-Shiller CAPE, or cyclically adjusted price-earnings ratio, which at just over 26 times trades on a level exceeded only twice before. The other occasions were 1929 and 2000, which gives some pause for thought. Both suggest some caution is needed, no matter how desirable some investors feel a haven away from the UK may be. So it may just be worth checking that the US equity market fits with your overall strategy, target returns, time horizon, and tolerance for risk. Thank you very much for watching, and I look forward to seeing you again next time.